Oops.
Hello students, welcome to my class. This is Professor Vincent Saga, and this is the presentation of part 1 of Stockholders Equity chapter 13. The first session of the class, we talked greatly about several accounting principles and concepts, how to apply those principles in order to prepare financial statements. Then we wind up shifting gear and we talk about several asset accounts as reported in the balance sheet in great detail. So we talk about accounts receivable, inventory, we talk about the accounting principles relating to those issues and how to apply them. Then we shift gear and we started talking about liabilities. We talked about current liabilities and payroll in chapter 11. Now in chapter 13, to wrap up the class, we are going to talk about the third component of the balance sheet, and that is the stockholders equity, So that as a backdrop, let's take a look at the objectives of chapter 1, chapter 13. We are going to identify the characteristics of the corporation. We are going to learn how to journalize the issue of stock. We are going to talk about how to account for cash dividends, and stock split. Then we are going to talk about how to account for purchase and sales of treasury stock, explain how equity is reported for a corporation, and then ultimately we talk about the earnings per share, a performance measurement metrics. So those are the learning objectives. Now let's take a look at the first objective, which is to identify the characteristics of a corporation. As a backdrop, recall a few weeks ago we talked about 3 different forms of organizing a company. In other words, every company has to be set up in 1 of 3 ways. Number 1, proprietorship. Number 2, partnership. And number 3, corporation. And we talk about the advantages and disadvantages of these 3 different forms of organizing a business. We also talk about the fact that there are different types of partnerships and there are different types of cooperation. But in a very simplified manner, we have 3 different ways or options of setting up a company. So in this chapter, we are zeroing in on the third, which is the corporate type of business. That is a company that is set up as a corporation. Now, we also said that it is possible that one individual owns 100% ownership of a corporation, and that is usually applicable to closely held corporations, your mom and pop shops that are set up as a corporation. But for the chapter 13 discussion purposes, we are going to be talking about the corporation from the standpoint of publicly traded company. Those are IBM, McDonald's, companies whose stock are available for the public. So, having said that, we also indicated that for this whole class, all the accounting principles, concepts that we learn how to apply them in order for us to prepare financial statements, we discuss all of these from the perspective of a corporation, not proprietorship or partnership. So that is the overview. So having said that, let's take a look at the advantages and disadvantages of a corporation. So let's zero in on the advantages first. You might not be able to see this slide because these fonts are very small, but you should have the benefit of your slides as well. So let's take a look at the advantages. Number 1, corporation can raise more money than a proprietorship or partnership. Yes, for example, IBM or McDonald's, these are publicly traded companies and they are able to sell a piece of the company to a lot of people, thereby being able to raise more money than a company that is owned by one individual. The second advantage, the corporation has a continuous life. So McDonald's has been in existence for a long time, and very likely is going to be in existence in the foreseeable future because it is not owned by one person. A lot of stockholders or owners of McDonald's will die, but the company will continue. So usually a corporation has a continuous life, especially publicly traded companies. Number three, the transfer of corporate ownership is easy. So you can go to downtown tomorrow and buy McDonald's stock or IBM stock for that matter. You become one of the owners of that company. And if you already have their stock or you're already an owner, you can go to the stock market and sell your ownership just like that, because there are buyers and sellers on a regular basis buying and selling this company stock. Number four, there is no mutual agency among the stockholders and the corporation. So, for example, I have some shares of McDonald's stock. I cannot make a commitment on behalf of McDonald's, okay? So the stockholders, that is what we mean by no mutual agency among the stockholders and the corporation. So the stockholders out there cannot make any commitment on behalf of the corporation. Number five, stockholders have limited liability, meaning if anything happens to a corporation, the owner or owners are not personally liable. That is one of the main advantages of setting up a company as a corporation. We said that the stockholders have limited liability, meaning their liability or their exposure is limited to whatever they invested in the company. So let's take a look at the disadvantages. Ownership and management are often separated, usually especially for multinational companies or publicly traded companies. The owners and the people that manage the company on a day-to-day basis are separate and different. That is disadvantage. So you're an owner, you really don't have an opportunity to partake in the management of the corporation. Number two, double taxation. What does that mean? When a corporation makes profit, the corporation is regarded as a human being in the eye of the law. So the corporation has to pay tax. Whatever is left is given to the owners in form of dividends. They turn around and pay tax on it again. So we call that double taxation. Number three, government regulation is expensive. A corporation has to comply with a lot of paperwork and with a lot of regulation as required by the government. So it's very expensive. Number four, startup costs are higher than business firms. So let's move on and talk about basic stock certificate. So what is it? The first thing that we want to talk about is, what is the definition of stock? What is stock? We said that a stock simply is a certificate that shows or is an evidence of ownership of a corporation. So if you have ownership of a corporation and you buy into the corporation, the evidence of your ownership is the stock certificate that is issued to you. So a stock is a basic stock certificate. Now, take a look at the elements of the stock, different characteristics, the name, the stockholder's name, so on and so forth. Another important thing that I want to draw to your attention right here is another word which we talked about at the beginning of the semester: share. Stock, share are two words that are used interchangeably. People just say share, stock, but they are two different things. A stock is a certificate that shows an individual's ownership of a corporation, whereas a share is a unit of stock. What does that mean? So if you buy 2 shares of IBM stock, you have less ownership than an individual that purchased 1,000 shares of the same corporation stock. So again, they are two different things. Stock, share. A share is a unit of stock. Moving along, let's take a look at the categories of stock. Now, the first thing that I want you to know here in terms of categories of stock is number one here is authorized. Authorized, what does that mean? The authorized stock, that is the maximum number of shares that a company is allowed to issue. In other words, when you set up your corporation with the government, for example, in the state of Illinois with the Secretary of State, you have to specify the maximum number of shares that you are willing to issue. So if you say 1 million and your application is approved, by law, you cannot issue more than 1 million shares. So we call that authorized shares. Number 2, we also have what we call issued shares. That is the number of shares that have been issued. So for example, if you have 1 million authorized shares and you issue 700,000 thus far, so 700,000 shares will be the number of issued shares. Then number 3, we also have what you call outstanding stock. That is the number of stock that is held by stockholders. Stockholders, shareholders, those are the owners of a corporation. So as you can see in this diagram, sometimes we have issued up to 700,000 shares. However, only 500 of the 700 are being currently held by stockholders. So we call that outstanding stock. Moving along, let's take a look at the voting rights. When you have of the stockholder, when you buy IBM stock, automatically you become an owner of IBM and you have some rights as owner. Number 1 right is you have the right to vote for the board of directors. Number 2, dividend. What is dividend? Dividend is a fancy name we use in business for the your portion of the profit that the company earned. So the company makes profit of $10 million, and the company decided to give a portion of that $10 million to the owners. So we call that dividend. So if you are a stockholder, you have the right to partake of the dividend distribution. Number 3, liquidation. In the event that the company goes under, of course, the assets of the company are being sold. Whatever is left has to be distributed among the shareholders. So you also are entitled to a share up to a piece of that. Then number 4, preemptive ownership. Just simply meaning if you have 20% ownership and the company decided to issue additional shares, they need to give you the opportunity to buy additional shares so that you can continue to maintain your 20% ownership. Usually for a lot of large corporations, they take that right away from stockholders because it's very complex to manage. Moving along, let's take a look at another concept here. We said preferred stock. Now, if a corporation is a company is set up as a corporation, the basic stock that the company must have is called common stock. Now, that is one type of stock. There is another type of stock. We call it preferred stock. What is the difference? A preferred stock has some preferences over common stock. Hence the name preferred stock. In other words, so if you decided to buy preferred stock, as a preferred stockholder, you have some preferences over common stockholders. And let's take a look at some of the preferences. Number 1, dividend distribution. When the company distributes dividends, the preferred stockholders are entitled to receive their dividend first. Whatever is left is given to, whatever is left, if any, is given to the common stockholders. Distribution of assets in case of liquidation. If the company goes belly up, then we have to sell everything that we have, pay the creditors. Whatever is left has to be paid to the preferred stockholders. If anything is left, then the common stockholders will partake of that. Now, we said that preferred stock is usually callable by the company, meaning usually the company will buy them back, usually stage the dividend rate as a percent of par value. What does that mean? That simply means that the dividend that the company is going to pay the preferred shareholders is predetermined. In other words, we know ahead of time the dividend that the preferred shareholders are going to receive. So how do we determine that? We said it's a rate, as it's a percent of par value. So if the par value of a preferred stock is $100, we can say that 1% of that par value is going to be the dividend for the preferred shareholder. So 1% of 100 will give you $1. So we are going to pay $1 per share to the preferred shareholders in form of dividends. And normally, no voting right for preferred stock. So I think that will be the end of part 1 presentation, and we'll continue the second part from this point.